You don't want to be the one that jinxed it.
No.
Uh,
So who does, let's see, who does someone in Michigan or Ohio root for now in the pros?
I like to root for good games.
Yeah.
You know, we haven't had much to root for as a Pistons fan in about a decade and a half, I want to say now. Coming up on 2.
it's kind of our diplomatic response. I probably would say not the Lakers. That's about as good as I can get.
As a Lions fan, we always say that our Super Bowl is actually the draft each year. So I think we received an A-, so we consider ourselves to virtually have won the Super Bowl already.
Winning the offseason, right?
I have a naive question, Chris. Have the Detroit Lions ever been in the Super Bowl?
We have not. We have won an NFL championship, but it was 1957. It was so almost 10 years before they actually invented the Super Bowl. I believe.
Also in the same boat. We have not won a championship since 1964, about 3 years before the Super Bowl became a thing.
So that means we're next, right? You guys have to wait until the Lions win one?
Yeah.
Good luck, my friend.
So, Rob, you can see the rivalry here, but yet we're brothers in sports misery. So we have to rely on our college programs to bring us some joy.
I understand. All right. How about this market, huh? So there's always something to talk about in the old mortgage biz.
Right. Well, welcome everybody into the Mother's Day weekend edition of the Rundown. So happy Mother's Day. Shout out to all the moms out there and all the moms of everybody on the line here. Hopefully you all have a lovely weekend coming up in store. Yeah, I mean, on this note, as always, Tom Galucci, Rob Chrisman from a undisclosed location, and guesting with us today, our good friend, Chris Bennett, principal of Vice Capital Markets. We want to shout out to Vice Capital for sponsoring today's episode. Vice is one of TMC's original preferred partners, actually predates my time with the organization. They've been in business since 2001. And if you've been under a rock, you haven't heard of Vice Capital, multitude of TMC clients that trust Vice to maximize their execution strategy, whether it's full service, hybrid approach, including your pipeline management, hedging, trading, rate risk management, file analysis, stress test reporting and analysis, hedge pipeline servicing, MSR evaluations, and much, much more. And on that note, I think I've gotten Chris's face as red or scarlet as my shirt today, because I know how much he loves the advertisements for his company.
Not scarlet, certainly, maybe a little red.
Okay.
Usually you used to see me in my office with my bookshelf behind me, which I had planned on, but do a little basement renovation project. And part of it is pickleball court and hockey rink rather, in the basement. So today was the day of painting all the lines, and kind of lo and behold, we discovered early this morning, when my basement was built, it wasn't actually built as a rectangle as all of our design plans had entailed. So a lot of today for me has been working from home and going upstairs and downstairs while we kind of remeasure everything and repaint everything, but should be good now. And so that's why my lighting is the way it is.
I know you got to import that clock everybody loves from the office. And speaking of pickleball, you got to challenge your fellow Michigander, Eric Burgoon from Lake Michigan Credit Union. I know he's an avid pickleball player.
Really? All right, cool. Fastest growing sport in America.
That's right. But Rob, you had your hand raised. Did you want to ask a question?
The problem with getting old, Tom, is that I forgot.
That's okay. I want to further embarrass Chris real quick. So
I know what I was going to ask.
Okay.
The thought popped into my head while you were reading all of the business channels that Vice Capital is in. Chris, how do you decide to go into whatever it is that you go into, knowing that you're going to butt heads with other companies who are already, hedging servicing, for example, or even hedging a pipeline, or I forget the litany of things that Vice Capital is involved in. How do you decide to go into a channel and decide if it's successful or not?
I guess from our perspective, it probably like a lot of other folks have found, just you find out when you hear that there's a need, that people have a need, and you think it's something that you can be really good at, and you give it a go. You find out what people want. I think probably like a lot of different folks that are in this industry, right? Even just all sorts of other vectors to it besides hedge advisory. Just you find out what people are looking for, and try and, if there's a problem, you try to solve that problem and see if you can solve it the very best of your ability. So I guess that's kind of how we've gotten into what we've gotten into. And things, for us, it's been 22 years now. The environment's constantly changing. What people want constantly changes. So you just make sure that you can change and adapt with it. Try to lead the way when you can, or at least if there's something out there that somebody else is doing that is a smart idea, it's okay to copy. We've had plenty of people copy what we do, and we're happy to do the same when something's a good thing that somebody wants.
And how do you gauge if it's successful or not?
Well, I guess you find out, right? You find out successful, but you measure it. You take a look at, here's what we were trying to do. Here's the gains we were trying to make, or the protection we're trying to provide. Did it work? And if it didn't work great, what can we do to tweak it to make it work better? I think that's a big part of it. Constantly looking to see what can we do better tomorrow. You can say that, and it's a little cliche. You can say that in a lot of different sports and a lot of different industries. What are we doing now? How did it do? And how can we make it better? I think it's a lot of it.
Well, clearly
Yeah.
you've done a lot of things right too, because in fact, Vice just launched another TMC client, Loan People, with a ringing endorsement from their CEO or COO and TMC fame, Aaron D., which you'll see in the weekly collaborative coming up this coming Monday, just raving about the experience in being able to consult, Chris, with you and your team through their vetting process, and strong confidence in the support from Vice Capital as they go live with you guys.
They're great folks and longtime TMC members too. It's just, that's a big, they participate so much in everything that you guys offer from a collaborative standpoint. That's, so we're pretty darn thrilled that they picked us. So really looking forward to the future together.
All right.
Thanks,
And
Tom.
my last banter point here, Rob, we'll get into the meat and potatoes of the mortgage industry this week. Chris, I want to say, I was going back to my notes. I think this is your 5th time guest hosting on the Rundown.
I think
And,
so.
I believe that makes you the leader in the clubhouse, rivaling Tracy King and Robert Senko and Robbie
Wow.
Crispin. And Rob, I'll work on a budget for this, but we may have to start our own 5-timers club like SNL and get
Oh, I
Chris
like that.
an honorary smoker's jacket or something to that effect.
I like it.
Absolutely.
It needs to be a special robe.
That's right. That's right.
I
Well-
typically will not be found working at 3:00 on Friday afternoons, but I love you guys so much. I couldn't say no.
Well, we appreciate you, brother. And I mean, on that note, I think the whole audience can celebrate. Obviously, it's been big news over the last couple of days. FHFA rescinding the proposed loan level pricing adjustment on DTI ratios, and originally set for May 1, then delayed to August 1, and now thanks in large part to industry voices like everybody on this line, MBA, our lender board, who sent a letter to Director Thompson, and countless others in this industry. FHA listened and reacted, and plenty of adult beverages probably to be toasted this weekend, and Advil to be converted to dealing with that, as opposed to the headaches from trying to explain late in the game pricing changes in a couple months to the consumers. So good way to send us into the weekend.
Yep, like I said, a lot of hard work.
Yeah, I don't think anybody wouldn't want the rescission, the change that the FHFA made. I think they were listening. I think though that I think rumor has it that they are taking a hard look at G fees and potentially raising those. But that's just a rumor. Just a rumor.
Okay.
Don't ask me where it came from. But they do mention pricing and a request for information in the body of their announcement from earlier this week. So, the good thing is that they listen to the industry. Another good thing is that Fannie Mae and Freddie Mac have so many trillions of dollars of mortgages that have passed through their system or that they're monitoring. They can really fine tune the pricing, and they know how to evaluate things and so forth. So it's very scientific. It's not like Chris and Rob's mortgage where, Chris walks in and says, oh, let's mark everything up a point. I want to make a point on all the loans in a very unscientific way. I would argue that Fannie Mae and Freddie Mac and the FHFA through them does things in a very, I would like to think, in a very considerate, thoughtful, calculated manner. And this time they may have done that, but I think the industry backlash was such that they, opted to change that back. So good for them and good for the industry. Although, and I'm going to ask Chris this, I've been doing some traveling recently, and the number of for sale signs that I see in my travels, they're rare. So even Tom, if rates, even if Fannie Mae and Freddie Mac had no loan level price adjustments and rates were 0%, if there's nothing to buy, then what's the diff?
Yeah.
So
Good
Chris,
recurrent talking point between you and Robbie and in the commentary too. You're right. If there's no volume out there, it doesn't matter what rates are.
right. So Chris, what are your clients? I mean, everybody was happy with that change this week, but do you think it'll really make a difference with your clients in terms of volume?
I think a lot of these things, they happen at the margins, right? Inventory is super tight. If rates drop by, pick a number, 75 basis points, does that make a huge difference? No, but does it help? I think it does help at the margins. I think a lot of these different things, both for purchase volume as well as for folks that where a cash out refinance can start making sense for them, because it didn't make sense at all at 6.5. But if you can look at dropping somebody's payment by $800 a month because of all the debt they have, because now you can do a cash out refinance at 5 or 5.25. Now you've added more people to the mix of people we can serve. So I know what you mean in terms of how tight it really still feels. Maybe not as much as 12 months ago, but you're right. I had my own subdivision here, 600 houses. I think in February there was not one for sale. 600 houses, 0 for sale. That's pretty darn unusual. But I do think that at the margins, if you do get interest rates to come down somewhat, now you have a lot of families that you don't want to trade your 3% mortgage for 6%, but trading 3 for 5, maybe that's something you can live with now that you couldn't before, because you really, really wanted this. You just couldn't have your payment jump by $1,500, but you're okay with it going up by $800.
Yeah,
Agreed.
So do you think that the well, from a managing risk point of view, does the change? I saw investors immediately jump in and change, also rescind this, the new matrix. Have you seen that across most investors at this point after a few days?
Yeah, I think actually most of what we saw was people that actually, when it first got postponed out to August, the DTI change, they pulled it off completely. Just kind of said, hey, we'll wait to hear if this ends up getting implemented or not. So we're not really seeing anything get hit with that. We kind of saw that big change happen, I'd say probably close to 2 months ago, when FHFA first announced that, hey, we're going to push this from May 1st out to August 1st, and we're going to reconsider. And that was certainly what they've done is the right thing to do. Like it's been talked about by so many, by MBA, certainly nothing is unworkable, but it's very, very difficult to work it and have it work out right. It becomes a chicken and the egg thing with ratios and qualifying and pricing. It was whatever the matrix is, and FHFA obviously they're trying to hit these goals while also doing, practicing good risk management. And it's a bizarre, sometimes balancing act, but I think we'd all agree they certainly did the right thing here.
Yeah. Have you seen much in terms of renegotiations or fallout, or let me ask that slightly differently. I had heard about 2 or 3 weeks ago that fallout had picked up, that for whatever reason, contracts weren't going through, things just weren't happening. Have you seen as a company, I'm obviously not asking for individual client information,
Sure.
but generally speaking across your clients, A small company might say, yeah, we want to start hedging. Our pull through is 85%. We're just going to sell a TBA security. We lock in $1 million, we sell an $850,000 security. We lock in another $1 million on Monday, we sell another $850,000. Have you seen pull through change or fallout change in recent months? And if so, why? Or if not, that's a good thing, I guess. But have you seen
Sure,
it? Have you seen it change much?
On a broad basis, and a lot of this really depends. Everyone's experience is kind of different, right? What kind of company are you? How are you going to market? How are you getting your customers? What kind of business is it? So it's kind of hard sometimes to paint it with a broad brush. But I think if I had to, well, interestingly, and this happens in a lot of these cycles, it happened last year, when we switched from a big refinance market to all those going away. This happened in 2022. We saw a fallout increase, not because it was market driven, because shoot interest rates were just going up every month, but all the easy deals were done, right? So now we're working on purchase transactions that are you're maybe trying to clean up a few refinance, but a lot of them they're purchase transactions that might be a little tougher. You've got qualification issues. They're fallout that isn't really based necessarily on market movement. They're just based on the deals, not the easy deals being gone and having some kind of tougher deals that you're working on right now. So we saw that, and that's eased back a little bit. We've seen that normalize. We didn't really see in the last 2 months on a broad basis a big uptick in fallout. I think a lot of it also is, other than that kind of little spike that we had when Silicon Valley Bank collapsed, we saw interest rates drop maybe 3/8 of a point in a few days. Other than that, we've really been, mortgage wise, in pretty much the same band. Going back for certainly since then. You can even kind of trace it further back, I think, even to the end of November, and say, rates are X plus or minus 3/8%, and 90% of the time we've been there. So it kind of feels like I was talking. I was on a fireside chat. The first time I saw you and Bill Case do one of those, Rob, about several years ago, I thought, well, that's a really cool format. That's a lot more fun than giving a speech. So at the Ohio Mortgage Bankers Conference, Brooks McDowell and I from Premier Bank, we did a little fireside chat and kind of talked about, hey, is this the end game for the Fed? And we contrasted what we did, what we were talking about last May to now. And it kind of felt like last May was, Ohio's the home of Cedar Point, the big amusement park. And you kind of felt like you're going over this first giant hill of the biggest roller coaster they've ever made. And everyone just starts screaming, ah! That's where we were in May of last year. And you go down and you survive, and you go up a big hill again, you go down again and you survive. And now a year later, we're kind of in the land of things being more calm. So it's kind of a little bit of a here comes the sun moment. Not that times aren't sometimes difficult for a number of lenders in a number of different ways, but we've gone through the hard times now. And we're steadying out. The market's kind of found its equilibrium place of the Fed says, the long run Fed funds rates around 3%. And so we have a 10-year yield of about 3.5%. Kind of more normal times, it kind of feels like out there.
Yeah, the when people ask me about lower rates, I say, what's going to make rates go lower? Is it that we get inflation under control, that we have another pandemic? And it inevitably brings up the topic about the spread between the U.S. 10-year, for example, and a mortgage rate, which right now, if you look at the 10-year, call it 3.5. If you look at mortgage rates, I mean, I'm just rounding this big time, but let's say they're 6.5. I think they're a little lower than that, but 3.5 versus 6.5 is a 300 basis point spread, 3% spread. And historically, it's been about half that. And so when somebody asks me about rates, it leads to a discussion about the spread and why mortgages are higher than maybe they should be on an historical basis as a spread to the Treasury curve. Do you have that discussion with your clients or with individuals out in the industry? And
I think so too.
What do you say?
Yeah, and I agree with you. I think a big part of it, and every time there's a big tightening cycle, that happens. The first thing that happens is the spread between mortgages and treasuries blows out. Mortgage buyers of these securities, right? As you well know, they don't like that volatility. They want things to be calm. And so the first thing that happens is that spread blows out, And then as the months go by and as the market kind of finds its footing, and if we're, I don't know if the Fed's gonna tighten again. I personally think that they're totally done. They got a nice, really pretty curve, and it looks great. So either way, whether it's the end game, we're at the end game, and that should be helpful. That really should. I mean, I think there's really, if treasuries don't change at all, I think there's room for a good 50 basis points in mortgage rates to go down. I think that just the buyers of those, they like stability, they like some calmness. It takes a while to kind of catch up, right? We had less supply out there until now. Of course, the FDIC's got some pretty big portfolios to sell of mortgage-backed securities, but those aren't 5s and 5.5s and 6s. Those are all 2.5s and 3s. So kind of a different part of that coupon stack too.
Do you have clients who hedge buybacks? And why I ask is I've heard rumors. I haven't seen anything concrete in terms of companies being asked by Fannie Mae and Freddie Mac to buy back loans that they maybe originated in a 3% world because of some kind of missing documentation, or the income wasn't calculated correctly, or whatever it might be. A, have you seen an increase in buybacks from the agencies? And B, what do your clients do with those loans? And are they hedged, and are they being securitized, or this just like, hey, Chris, I need a scratched and dented buyer, and you refer them one. What's going on out there in that segment of the industry?
We at least haven't seen a big increase in buybacks. I've heard chatter about a lot of people that have fear of it, that, hey, this is coming. And maybe they've heard it from big correspondent buyers that suddenly got a lot tougher on their requirements, or are coming back to them for a loan they sold them 6 months ago and 9 months ago. And the correspondent seller saying, what are you talking about? This is from 8 months ago. What suddenly is the problem? So I feel I'm hearing a lot of fear of that. I'm not seeing it actually happen. Not yet anyway. Who knows what tomorrow brings, right? If anybody would know, it'd be you actually, Rob. But there's what I kind of see is, if somebody does have to buy a loan back and it's something that's going to be sold scratch and dent, there's almost no point in hedging it. If it's something that you're hoping to sell for 75 or 80, it's not really that correlated to what happens to interest rates. If it's something that you're immediately able to securitize again, so it wouldn't be a buyback, but say a loan modification. You've got a servicing portfolio, you're modifying loans, they've made their 4 payments, now you're ready to repool them. We do see people hedge those because that's going to be a much more normal type of loan, and you really do have interest rate risk that gets to manage there. So I think it really kind of depends on, is it a buyback where now you got scratch and dent where it doesn't really matter if rates are at 5.5 or 6, or is it something where it's from the servicing standpoint and you're able to repool it? It's kind of what we see.
Now, good answer, because yeah, you're right. If something's so far out of the money, the issue isn't interest rates. The issue is trying to find a buyer.
Right.
And I think that, there's a lot, if you've got capital, and you can make a market in those scratch and dent loans, I imagine most of them are making their payments. The borrower doesn't want to sell the house.
Right.
The borrower likes the interest rates. They don't want to lose that loan. They don't want to go into foreclosure. There's all kinds of things where if you buy a loan 75 or 80 cents on the dollar and they're making their payments, then great. And if the loan pays off, then you get a 25-point gain.
Exactly. Yep.
Not a lot of downside if you're a
why
buyer.
eat it if you don't have to, right?
Right. Is there anything, I know we're going way off script here, not that we necessarily have a script, but is there anything new in the world of hedging in terms of instruments, or is it strictly to be announced, CBA, generic mortgage-backed securities is the way to go?
There are a couple of things that are trying to gain traction. One is futures that are based on the average interest rate that gets published. Actually, Optimal Blue publishes it, so futures that are based on that. And another are actual TBA futures that are out there that ICE has put out. By gaining traction, they've just gotten to the point where I think maybe it's 100 million. I think I want to say the month of March was 100 million in trading for the month, which is really kind of a drop in the bucket, but everything that ends up becoming popular starts from something small. So there's a few things out there. I guess it kind of remains to be seen if it gains traction or not. Or I mean, sometimes you can have a case where having a new market come about helps provide liquidity in other related markets as well. So, the fact that there's a corn futures market helps provide good liquidity in the corn cash market. That kind of thing.
Yeah.
That's what we're seeing. Have you heard of some other things as well that are out there?
No, that's why I genuinely wanted to know. And I look back because when I got started in the business back in the 80s, it was always mortgage-backed securities. And every once in a while somebody would pop up. I won't name names or companies, but we can trade, we can put on futures, or we can put on options, or here's how we hedge adjustable rate mortgages, or here's how we hedge extended rate loans. And so every once in a while, some slightly alternative, some alternative would pop up to the TBA market, but it just seems like the MBS market is tried and true, continues to dominate the lion's share of any hedging activities. So,
yeah, are you sure?
Are you guys handling intermediate arms, hedging those?
We are. There's just not many of them, right? When you've got an inverted yield curve, it's kind of by definition, right? Short-term money costs more than long-term money. So, and the whole time as an industry where we could have actually had lower rates for ARMs than for fixed, when we actually had a yield curve that wasn't inverted. Well, fixed rates were so low that who wants to take a chance? Just if you can get a fixed rate for 3% or an ARM for 2.5%, everybody wanted to take the fixed at 3%, right? It's such a historically good deal. Who wouldn't want that? So now when we get to the point where fixed rates, a year ago shoot through the roof. Unfortunately, ARM rates did the same thing and kind of fell apart even more spectacular fashion. So, the ARMs are always out there, and especially I think when you get to the non-QM side, when you're looking at portfolio things, those are always the darlings, right? Of you've got you're a bank that wants to keep things. You don't want to put 30-year loans on your books, as some of our bank friends have seen recently. So an adjustable rate mortgage makes a lot of sense, and especially when you're dealing with jumbo loans and sophisticated borrowers who are comfortable and understand how an adjustable rate mortgage works and are okay with that risk.
Yeah. Have you seen much in the way of new jumbo investors? I know with Wells leaving correspondent and now First Republic, Chase, Jamie Dimon basically saying we're going to offer cheap mortgages, or whatever Jamie Dimon said. I should look up that quote. But what's going on with the jumbo market? Have you seen that fall off a cliff, or are your clients seeking out community or regional banks or credit unions and forging relationships with them to supply them with jumbo business?
I really think, Rob, that really is the key. If you're somebody that does 3 or 5 jumbo loans a month, that's one thing. But if you're a bigger lender and if jumbo is a pretty big part of what you do, I think that's exactly it. It's forging those relationships with, especially if it's a community bank that's in your area, or at least is big enough that has a footprint in a lot of areas that have your footprint, where it's more important to them than just putting an asset on their books and they're happy with the interest rate spread. Those are some really good deals to put together. And those are kind of, who's doing that? Well, it kind of depends on who you are, right? And a lot of the folks that make those deals, they don't really want everybody else out there knowing about them. So I think it's about getting to know lenders that are local to you, or even kind of expand that bubble out a little bit and saying, here's what we can offer. Here's what we can offer you as an end buyer of these. What can we work out together? And you got to be able to be a little creative. This isn't, if you work out something like this isn't something that a loan officer is going to make 150 basis points in that low comp on. You're going to have to work out something that's going to work out for all parties. And you can do that and still be compliant.
It's a fantastic point. It's one of the most common questions we get from the lender members of the network with, Chase Wells pulling out the jumbo space. Is there somebody out there that's going to offer that similar pricing benefit? And to your point, you got to get a little more creative and look local and foster those relationships. Some good comments in the chats just over the course of your guys' insightful back and forth. So apparently there's some homes for sale in Kansas through our audience, which is always great to hear. LOs and underwriters saying that auto loans are very hard right now. No easy files, no surprise there. And I think more lenders trying to use automation tools in the underwriting space to divert some of those vanilla files and leverage their human brains and talent to figure out some of those more complex loans. Interesting comments in the chat, just kind of on the rate front. I'll read it off here. New article regarding debt default making the rounds yesterday and today, and I haven't seen this, is stating in quotes, Zillow estimated that mortgage rates could reach 8.4% in the unlikely event of a debt default. And if rates were to go that high, then mortgage payments on a typical home would soar upwards of 22% by September of 23. Unlikely event, yes, sells clicks, but worth a discussion about potential impacts. I see you shaking your head at that right away.
It's one of my pet peeves. Either somebody in the restaurant, when I give them my order, they say perfect. What's perfect about my food order? But the second thing is these sensationalist headlines and Audrey, there's Audrey. Why do they write stupid articles like that? It's the headline. I mean, Rob Chrisman. Exactly. And I always make not always, but sometimes I'll make a joke that I'm just going to put some outlandish statement in the subject line of my little commentary one morning. And then when people open it up, it's just going to say, just kidding, just wanted you to open it up kind of thing. Because
it's like get enough blowback for the jokes at the end of the very bottom of your commentary.
Right. But it's like seeing a road sign. Bridge may be icy. Well, bridge may not be icy. You don't know. It's either icy or it's not icy. Maybe icy, maybe it's not icy. These headlines come out and it's like, large percentage of Americans worship Satan. And then you click on the link and it's like, 1%. And you think, why did they say that in that headline? So coming up with some number like 8.3, makes it sound very specific, and it is scary. And if it incites people to contact their congressperson and beat them up a little bit on, what the heck, the article that I saw, Tom, now you really got me going here, Tom. And sorry, Chris, you can chime in a second. But the article that I saw had that headline, and then it had a picture of Joe Biden next to it. Joe Biden doesn't have anything to do with that, right? The budget, the spending, that comes out of Congress. It's not, Joe Biden. It's not Joe Biden. Joe Biden's waiting for Congress to come up with something. And I know the staffers are speaking, but yeah, it's headlines like that just get under my bonnet.
Now we've got Rob Gooden fired up here. Wanted to touch on other couple things you guys brought up earlier. Obviously, the inventory challenges out there. There was a good report from Redfin this week, and I don't think it's surprising to our audience at all, just that because of low inventory, the bidding wars as we head to spring buyer season starting to shoot back up. Specific stats, supply rising, but still only up to 2.7 months, which is well below that kind of 6-month target mark we're all looking to get back to. And that homes on the market for a median of 33 days in the month of April, which is the shortest span since fall of last year. So feeling it out there nationwide. And Chris, you kind of tapped in. It sounded like it was part of your discussion with Brooks at OMBA. And so real quick on that front, I know the title of it was Updated Mortgage Markets and Other 4-Letter Words. This is a family show, but I'm interested if there's any 4-letter words that came out of that discussion that you can share with our audience.
Yeah, I didn't write the catchy title. I'm not sure where that came from, but I'm guessing it harkens back to 2008 when we had TARP and TALF and I think BARF, whatever that was. So now, and the latest one, of course, since the weekend of Silicon Valley Bank is the BTFP, the Bank Term Funding Program. So I think that's where that actually kind of came from. It was a really, really good. People were pretty upbeat. So it was a good conference. A lot of people just trying to kind of find out what's the next thing they can look at. How can they do better than just sort of survive in this kind of environment? And really, I think we're kind of here from a production standpoint. Not closings right now, but gosh, if your June and July closings should be able to make for profitable months. And if they aren't, you've got to figure out something pretty quick about how they can be, because this is the environment we're going to be in. We're going to be in it for quite a while, I bet.
Oh, spot on. You mentioned earlier too, just the concerns around the banking sector. I know big headlines yesterday was PacWest stock plummeting 25% after they had to disclose, I believe it was deposits were down nearly 10% through their security filings just over this past week. But keeping eyes on them today, naturally people look towards Western Alliance and First Horizon have taken headlines, but those stocks have seemed to stay relatively flat. So feel like the markets aren't as reactive to maybe some of those updates. But did you
It's
get a lot
interesting
of
when,
those questions in your session at OMBA?
Yeah, when Silicon Valley, collapsed and, in a weekend, all these things got done. It's interesting. Everybody was pretty kind of quick to say, well, it was just Silicon Valley was bad and dumb and they made terrible decisions and they blew up and that's why, and everything else should be fine. I think it's Jamie Dimon loves the quote of, it seems to be contained, but there's never just one cockroach, right? And turns out there wasn't just one cockroach. But in the end, I think it's a case too where, listen, banks are businesses. Businesses are supposed to fail sometimes. Banks are supposed to take risk. They're supposed to manage those risks. And in this case, obviously, there's more than a few banks that got over their skis, right? They, the whole thing in banks a lot of times is you lend long and you borrow short, and things change so quickly. I mean, the Fed in its own forecast didn't forecast that they were going to be raising short-term rates by 500 basis points, right? So, did some banks get caught over their skis? They sure did. But it seems to be, and I'm curious if you guys both think this is also the case, there's a little bit of a crisis of confidence, right? Where, I saw something of, if every bank had to market their portfolio, 50% wouldn't meet 1,000 of them wouldn't meet their capital requirements. And that be that as it may, they don't have to mark them to market. So we don't need to kind of hold them to that standard. But there's also the part, I saw an analyst write up on this about a week ago, that it's about keeping your name out of the news wires, right? That half of all banks could not withstand a 90% reduction in their deposits. And that's what gets these banks. The ones that suddenly collapsed were, they're upside down in terms of here's where they've lent and here's where the deposits are. But as long as there isn't a run on them, they're okay. They're just not making much in the way of money, but they're fine. It's when we have this run, when suddenly there's this tremendous fear. And, frankly, if you're managing a bunch of money that's far in excess of $250,000, and all it takes is click for you to get out of this bank that's in the news and go to this other bank, you can't be wrong, right? You can't lose. There's no financial penalty you're incurring for doing that. So that's kind of the scary thing is, there's a lot of banks out there that are just fine and doing well, but what if there's a run? And what do you do about it? That's kind of the part that's disconcerting.
Right. The biggest thing you can do is get out there and remind your clients why you do business with your local or regional bank and the benefits that they are getting out of there versus, say, the top 10 out there. But thankfully, this isn't the St. Patrick's Day episode where Rob can't make me drink every time the Fed or DIC gets brought up. Because, that's the biggest fear, Chris. You're right. These are largely sound banks. But if you get caught in the headlines, and the speed of information and the speed of technology allows you to move large sums of money out in a heartbeat, a run can happen really fast.
It can. It sure can.
Which, speaking of, do you guys hear about this? I've heard rumors of it, was doing some research that the FDIC considering insuring all deposits to kind of assuage that public fear out there. And nothing decided yet, but kind of the latest intake on that front is that yes, for business accounts, no for personal accounts, and that while they want to keep the threshold at 250K insured for personal accounts, still kind of hashing out who would qualify from a business account, or maybe it's an amount perspective too out there. Guys, any thoughts on that?
See, I thought changing that required an act of Congress. Maybe I'm wrong, or maybe they would just propose it to Congress. I don't know. There seems to be a de facto guarantee there, right? But how much does it keep pummeling the FDIC's insurance fund, right? What I think the latest I saw was there's going to be a kind of a special assessment on if you got more than 5 billion in uninsured deposits there. It's out for 60-day comment period, I think. I don't know. Does it? Maybe we should. It's probably an over the head by question on my end. What do you guys think?
Well,
I haven't followed it, so
Yeah.
I'm gonna be naive and play that card. There's a lot of proposals. There's a lot of different people saying different things. But I haven't followed the proposals.
I mean, a couple people I trust on the banking side say, you know, we need to do a better job telling the story of what really takes place here. If there is a run on the bank and you have uninsured deposits, in large part, I think the numbers I got were you could maybe risk losing up to 15 to 20% of your total assets, but that you would get that large mainstay, some of that back within a week or two of the bank shuttering there. So, you know, that's a huge sum of money, but I think it could quell some of those fears out there. And looking into the chat from the audience,
There's actually some really good comments in there, actually.
Yeah. From David, could it be that investors who are shorting bank stocks are the ones that are finding ways to whisper out negative stories about those banks? I saw Jamie Dimon make some comments on that just the other day.
Absolutely.
You know, empowering regulators to go after those people through the full extent of the law. Andrew Young says special FDIC assessment for banks who will assess a special assessment on customers. And then Stephen Curley asking, what would the inflation adjusted amount be when the 250K was set? That's an interesting thought too, considering that amount was set back in coming out of 2008 crisis.
Yeah, because we were $100,000 for up until you're right. The 2008 crisis got changed to temporarily 250, and then they made it permanent.
And one more great comment out here too, that stabilizing commercial deposits should stop the crisis of confidence. Those deposits are the lifeblood for regional banks. Still doesn't help the issue with deposit betas.
True. Very, very good comment.
Well, guys, we're running low on time here. I know people want to get on to their weekend, so I always like to close it light. Chris, you got any good plans for this Mother's Day weekend?
Actually, my son, my 14-year-old and I are playing in our pickleball tournaments tomorrow morning, so we're pretty pumped. It's getting there at 8 a.m., so it's gonna be bright and early, but should be a lot of fun.
Oh, well, good luck to you both. I'm sure Rob will be rising about the same time on the West Coast. Well, you got a big game tonight, so maybe not. You're going to be playing basketball tomorrow morning?
No basketball tomorrow morning. I am playing tennis with my buddy, I'm playing tennis tomorrow afternoon well, I don't want to go too far down that path, but he's actually an ex-carpenter who lost his leg in a car accident and now he has a titanium post as a prosthetic. He gets around better than I do. He's like the bionic guy out there. So he does just fine. So I'm playing tennis with him.
Well, he's probably got some good odds on you if you're up late watching that Warriors game tonight.
Exactly.
How about you, Tom?
Exactly.
Me, it's sports day tomorrow. I've got son's final flag football game, baseball practice, and then going to spend the day and Sunday with Mom and go out and see grandparents' grave, which is at the same cemetery as President Garfield, and then go treat my wife properly. So happy Mother's Day once again to all the moms out there. Hope you all have a lovely weekend.
And Tom, when's your birthday?
It'll be at NBA secondary. So
Oh,
feel free to toast one with me on Tuesday night if you're out in New York for that event.
I'll be there.
Oh,
Big
fantastic.
4-0.
Big 4-0. Cool.
Right.
Happy early birthday, Tom.
I appreciate it, brother. Well, Chris, always love having you in here. Thank you. Thank Vice Capital Markets for sponsoring. And until next Friday, have a great weekend, everyone.
Thanks.
Thanks, Tom. Thanks, Rob.
Thank you very much,
Thanks,
Chris.
everybody.